Well, hello and welcome to another episode of the Capital Record. I am your host, David Bonson. I'm very excited to have yet another first-time guest joining us this week on Capital Record. Many of you will be familiar with John Tamny, who is the editor at Real Clear Markets. He has been a writer in all matters economy at Forbes for quite some time. Affiliated with FreedomWorks, written at Wall Street Journal, Financial Times, even here at National Review. And I originally read a book that he put out called Popular Economics. I actually have read a couple of the books that he's written over the years, but there's very rarely been something that I read and I said, oh, he's not on the same page. Even when I disagree with John on something, I can tell he's coming from a very similar and compatible philosophy. Now, I'm going to have him on right now to talk about inflation and the dollar and a lot of these kinds of things. That's probably going to lead to some agreement and some disagreement. But I really enjoy John's contribution to the subject. He's very willing to go against the grain of consensus thought. He is an ideological thinker about economics, and he's just seeking desperately, like most of the good guys are, to apply his principles in a consistent and cogent manner. Let me bring on John Tamny. So with that said, let me welcome another first-time guest to the Capital Record. Welcome, and thanks for being with us, John Tamny.
Hey, David, thanks for having me. It's great to be here.
So, John, there's so much stuff that we could talk about, and I'd love to have you on the podcast more periodically. I know from having read your work for a long time and spent time with you that we are kindred spirits on so many things. The whole purpose of this podcast is a defense of free enterprise, including the financial markets that we think are important to maintaining and sustaining a free enterprise system. But I guess right now, everyone wants to talk about inflation. And maybe you and I should talk about that a little. And then when we get bored of it, we can move on to something else. The people who listen to Capital Record are pretty familiar with my view on the subject, so I won't bore everyone there. I'm just going to bring you in and ask you, what do you think about the current talk around inflation?
I think the current talk about inflation is thoroughly insulting. I think it makes Barack Obama's "you didn't build that" seem complimentary by comparison. And I think it's rooted in a thorough misunderstanding of what inflation is. Inflation is quite simply not higher prices. All sorts of things can cause prices to rise. And the fact that prices are higher today should be a statement of the obvious. And it should be based on how we understand Adam Smith. What was the most important thing in The Wealth of Nations? It was his observation from going into a pin factory that one man working alone could maybe produce one pin per day. But one man working with several other men could produce tens of thousands today. The simple truth is that when we divide up work, our ability to produce enormous amounts of goods and services expands in wildly exponential fashion. And so you look at the lockdowns that happened in 2020 that eviscerated trillions of commercial relationships entered into by billions of people around the world. Is it any surprise that prices are higher today? None of this has to do with supply or demand. You can't produce as cheaply when you're not working together. Yet we have politicians blaming the Fed, which the Fed is just a joke, but blaming the Fed for what they did. They locked down the economy, and no one's tying the two together.
So in a traditional sense, the old definition that we've all heard over and over again of the definition of inflation being too much money chasing too few goods, and I always add, and services. I think Milton would be okay with me doing that. So if we say that inflation is too much money chasing too few goods and services, do you A, accept that definition, and B, how would you apply it in the current context?
No, I reject the definition. Let's never forget that all trade is products for products. Money is just the agreement about value that we use. So because I have bread, but I want your wine, but you want the butcher's meat, and so money is the most stable measure we can find to actually move goods and services around. And so the definition implies that producers are actively willing to take less goods and services for what they're offering. As in, I've got a truck, here it is, give me your cheap dollars, pesos, yuan, yen, whatever, and I'll take it and get less for it. Most aren't willing to do that. To me, inflation is a departure from a standard of value. Too much money is what happens after we've inflated. We pursue a strong, stable dollar. We pursue a dollar that maybe has a commodity definition. The departure from it is the inflation. The rising prices that happen after the fact are the consequence of inflation. And so I think there's a mistake. It's being made in a big way by our side right now. They're tying inflation to money supply. Money supply is, you're on the wrong track when you're talking about it, but money supply is a problem only after we've done the damage to the currency.
So let me ask it this way. I have considered it self-evident for some time that a rising money supply in and of itself is not the definition of inflation. The notion that the supply of goods and services growing 10% should not come with an increase in money supply that is somewhat commensurate has always struck me as silly. And of course, radically deflationary as well. But when you talk about disconnecting from money supply entirely in the way we think about this, if we had no movement in the production of goods and services, no input, no movement in output at all, and had a doubling of the money supply, to just make a ridiculous, analogy, would you expect that to be inflationary?
No, because as you've just alluded, what people assume to be inflation isn't. A rising, quote, money supply is arguably the surest sign that there's no inflation. Because money that is cheap or declining in value quickly ceases to circulate. It's too easily forgotten that in Germany after World War I, marks were scarce, and they were scarce because no one accepted them. It's only when money is good that it's circulated. And so you bring up the point that, okay, well, what if there's no increase in output and they double the money supply? Well, it's not going to be inflationary for a variety of reasons unless you devalue the currency. Again, the devaluation is the inflation, but you couldn't increase money supply in your best day. I mean, if it were true, if we could do that, let's increase money supply in West Baltimore. Everyone's poor there. But see, if we did that, the money would flow out of Baltimore within seconds. Just the same, if the Fed suddenly started selling bonds to banks in Silicon Valley to decrease money supply there, market actors would make up for that mistake within seconds. Money supply is a market phenomenon. And so when monetarists, including the Milton Friedman crowd, claim that it can be planned, they would cause Soviet central planners to blush. Markets plan money supply. As our friend Arthur Laffer has pointed out in the past, money supply is production determined. That's why we never need to worry about it. As long as the currency is credible, the rest is taken care of. And even if it's not credible, market actors will get the correct money concept into where there's production.
So, is there a sense, John, in what you're saying, you're just sort of breaking down the meaning of Fisher's quantity theory, but effectively what you just said is that the reason a higher M does not equal a higher P is because the velocity will contract. And so I have made this point not prescriptively, but descriptively, that with Japan and with the last, let's call it 20 years almost of American economic life, we already know this to be true, that higher money supply did not equal higher price level because it was offset by velocity. a declining velocity. It sounds like what you're merely saying is that embedded in that algebraic equation, you're explaining why it is that the velocity contracts when the money supply goes up without a commensurate increase in goods and services. So markets do the work for us. Quantity theory of money just describes what markets are doing, which is velocity offsetting increase in money supply when output is not appropriately increased. Is that a fair summary of your view?
I think it's a fair summary insofar as this is a market phenomenon. Where there's production, there will always be money. And this is true in North Korea. What is the currency of choice in North Korea? It is the dollar. If you want to do business in North Korea, you will not have won in your pocket, you will have dollars. If you want to do business in Venezuela, you will have dollars. If you want to do business in Iran, you will have dollars. Did the Fed plan this? No. Where there's useful goods and services that people want to move, which is why you produce goods and services, good money will always be there to move them to a higher use. Probably my one quibble with the velocity is, for one, I think it's dangerous to think about velocity in the first place. Does anyone think that Fred Smith at FedEx is spending time on velocity? But I think good money, by definition, is being moved around all the time because good money is wherever there's production. And wherever there's production, you don't have Argentine pesos or Venezuelan bolivars or North Korean won. You have dollars. Again, even though governments issue currencies today, markets dictate what currencies we use. And the dollar, it has its weaknesses, and you and I know them. But the dollar is the world's currency. The whole world is basically dollarized, even though the Fed is not pushing money supply around the world.
So I have the distinct advantage in our conversation of knowing what you're going to say to this and appreciating it in advance of what you're about to say. But I do think that it's fair for listeners to get the devil's advocate out of the way. That the immediate and logical response to your point is that it begs the question about credible currency, that it is not about money supply. It's where there's going to be credible currency that then has a demand for that. And you're using dollars as that great example. But of course, doesn't that presuppose that the credible currency means there isn't outlandish behavior with the money supply? Can a currency stay credible if there's helicopter money?
Probably not. But if that's true, if they're quite literally dropping dollars into somewhere, what we know is soon enough that currency will no longer be circulated. Basically, Gresham's law is anything but. In the real world, good money always pushes out the bad. And that's why if you're in Argentina right now and you want to buy a car from David Bahnsen, good luck sending him pesos. You will send David Bahnsen dollars. And if you don't have dollars, you will send him Swiss francs. And so it's one of these things that it's a natural market phenomenon. And that's why I find it so frustrating right now watching people from our world focus on money supply and saying, well, this is the signal of inflation. The fact that dollars are so heavily circulated around the world isn't to say that the dollar is perfect. The dollar has many demerits, and I think ultimately the dollar will be replaced. But what it does say is that we don't have near the inflation problem that people think, and we know this because the dollar is the currency of choice in just about every global transaction, and it's everywhere that business is being transacted in just about any part of the world.
It's interesting because I would say that there is nothing that the right has gotten more wrong economically in my adult life, well, in my entire lifetime, actually, than doom and gloom prophecy about inflation. But I guess the one thing that might be the caveat there is doom and gloom about the dollar. And your point, the logic you're using would really effectively make those errors one and the same. That they've gotten inflation wrong because they've gotten the dollar wrong. And this ongoing assumption that the dollar is about to collapse leads them to necessarily make other bad prophecy as well. But have you, just as a pure matter of history here, just history, not even our own economic theorizing, Have you ever seen a period where they say inflation's the highest it's been in 30, 40, and 50 years, and the dollar has gone up against every single currency on the planet?
I love your question so much because that's what I've been saying too. I've been saying this would be the first inflation in the history of mankind in which the dollar actually strengthened during the period in which they say there was abundant inflation. And let me just add to your point. I'm with you. I've never seen our side, the right, get something so wrong as they've gotten inflation right now. But I just want to add to it. They're talking about inflation right now as though Joe Biden, this empty suit, is the second coming of Jimmy Carter. He wishes he could be Jimmy Carter, but let's also remember these same individuals talking about inflation were nowhere to be found in the early 2000s when George W. Bush was president and the dollar collapsed versus gold. Gold was $260 an ounce when Bush got into office. When the dollar collapsed against oil, let's not forget that oil hit $150 a barrel at one point in 2007. And let's add that the dollar fell against the euro, yen, pound.
Well, and by the way, it fell by 60%.
Yeah, it was a bloodbath for the dollar that was made apparent, just like it was in the 1970s, by soaring commodity prices. Yet conservatives were nowhere to be found to say, look at what the Bush administration, because presidents get the dollar they want, is doing to a currency that had been healthy in the 80s and 90s. Yet suddenly, in a period when the dollar is rising, they find inflation everywhere they look, and they refuse to look at the lockdowns as their source of the higher prices. So they're not only misdefining inflation, they're showing that to them it's a political thing more than anything else because they refuse to acknowledge the past and a president from their side who oversaw the biggest inflation since Jimmy Carter.
Well, I'm going to add a third thing they're doing because both of those two things you're doing are completely spot on and important and at the heart of this matter. And so you have a total ally in that underlying point of what they're getting wrong. But there's a third piece they're doing that's implicit that is just catastrophically dangerous, is they are implying that both Congress on the fiscal side, by blaming Biden's spending bill, the first 20 trillion of excess spending this century wasn't inflationary, but the last 2 trillion was. It's the stupidest thing I've ever heard in my life. But secondly, they are implying that the Fed has an ability that I have wanted to spend most of my adult life claiming the Fed doesn't have. The Fed cannot, if they could, Japanese central bank would be the most powerful entity on the planet. But pushing on a string in monetary policy does not produce goods and services, and it does not generate output. It does not impact human action. And this idea that I'm not saying the Fed funds rate should be 0%, and I don't care if house prices come down or stocks come down while they go from 1.5 to 2.5 or whatever the rate terminal rate ends up being. However, this idea that the Fed can just use the interest rate and it's going to generate oil supply is so stupid and counterintuitive to a human action minded market economists that I can't believe we're listening to this.
Amen 1,000 times over. Where do we start with this? We have Republicans and prominent conservative economists saying that the government spending is causing excess demand. There is no such thing as excess demand. We supply and we're subsequently able to demand. Government spending, and we could talk for hours about the horrors of government spending. But government can only hand someone $20 insofar as it takes it from someone else. There's no increase in demand. There's just a shift in demand. Yet out of nowhere, to your exact point, because Republicans have been overseeing massive increases in spending for quite some time, that was never inflationary, but suddenly this is. And then they turn their focus to the Fed. Oh, then they go to deficits, as though deficits are suddenly the source of inflation when, my goodness, we had them under Bush and Trump, and there was no talk of inflation at all, as you allude. Can we also just go to one other thing about this? The Fed And we could talk for hours about how the Fed's power is vastly overrated. But the dollar's exchange rate has never been part of the Fed's policy portfolio. In 1933, FDR chose to devalue the dollar from 1/20th of a gold ounce to 1/35th of a gold ounce. Fed Chairman Eugene Meyer begged him not to do it and was told to go fly a kite. Meyer resigned over this decision. In 1971, Fed Chairman Arthur Burns thought Nixon was nuts to delink the dollar from gold. He begged him not to do it and was once again rebuffed. Presidents get the dollar they want. Devaluations are as old as government money is. To tie them to central banks is not only historically inaccurate, but it's the height of unsophistication. It's what stupid people talk about. An ideology rooted in good ideas is now it's the dumb party. It's full of people who don't have a clue about what they're talking about.
Well, and here's the political danger. I was thinking about this with the Manchin-Schumer bill being called the Inflation Reduction Act. And I completely agree with all my political friends at National Review, who host this podcast, and basically throughout the political right, that it is not an Inflation Reduction Act, and there's a lot of bad things about it, and I'm vehemently opposed to the bill. But here's the thing I think is politically genius of what they're doing. I think the rate of inflation is coming down, and I think they know it's coming down. And what I mean by the rate of inflation is how it gets measured in CPI and these other aesthetic measures that are being used right now as a blunt instrument against them. So they're setting us up for a post hoc fallacy that we will have no counter to, because we said inflation was their fault by them doing something. The implication will be that a reduced inflation is their credit by them doing something. I think we're walking into this trap. The notion of consumer prices going up 9% a year was never sustainable, regardless of what the Fed funds rate was at. Anybody could see the COVID impact from the lockdowns and then the reopening and the supply chain disruptions. Now, look, I'm very willing to find policy errors. I think that they exacerbated labor shortages. There's all kinds of other challenges out there that are inhibiting the output problem. However, I believe that we essentially are probably going to be guaranteeing the Democrats a talking point about inflation. And it's not just in the short term that they'll be able to say, look, we brought down inflation. It's long term. The academic argument will be, hey, we can turn inflation up and down whenever we want. And how do we know we can do it? Because the Republicans just told us we can do it.
Yep. You are so right about this. They have handed them a victory because the Fed was right about this all along, and that while they define inflation in completely wrong fashion, as you allude, high prices by definition are transitory. Of course they are. High prices in a normal world are a summon for more of whatever it is that people want. And so high prices were, of course, going to lead to lower prices. The problem is Republicans, in their desperation to change the subject or whatever, have turned high prices into inflation. But the reality is, if we're demanding Honeycrisp apples more because they cure heart disease, such that we're driving up their prices, by definition, that means that other goods and services are declining in price. A rising price implies a falling price elsewhere. None of this is inflationary, and Republicans have basically locked themselves into a definition that's going to make them look really foolish, as you allude.
Now, do you agree with me, though? And I wonder if we might have come across the potential for our first disagreement, but I don't think so. I argue the government subsidies are inflationary in that they distort prices outside of market mechanisms. And so the notion of permanently escalating housing prices outside of wage growth, population growth, any other market circumstance, but merely because of it being such a levered purchase, essentially a backdoor subsidy through Fannie and Freddie that own the mortgage market. But even a more direct subsidy would be healthcare. A more direct subsidy would be higher education, student loan market. Do you think that the price inflation in those price increases in those three heavily subsidized parts of the American economy, does that count as inflation?
No, and I think you probably agree with me in how I'm saying no. If suddenly we're paying 80,000 a year for Yale when in 1995 it was 21,000, that by definition means we have 59,000 less to buy other goods and services. This isn't me
Yeah.
defending the subsidy, but it's just whatever causes something to be more expensive, as a rule, that means that we've got fewer dollars to purchase other things. Inflation is a devaluation of the currency. It's nothing else.
So what you're
Um,
doing is making a economic argument against the concept of a price level as an aggregate price level, which is another misnomer I think we should discuss. But your point is that if Yale goes up X, something else went down. And so you're making a macro argument that that is not inflationary at an aggregate.
Yeah, it can't be inflationary if I'm paying more for the comic book because it's popular. I've got fewer dollars to buy other things. Now, I think it's useful to point out, however, that inflation, as I think we define it, a devaluation of the currency, does logically have an impact on certain prices. If you look in the 1970s, is it any surprise that housing was the top asset class? Well, no, the dollar is devalued. And so people are, von Mises, what did he used to say? There's a flight to the real. There's a flight to wealth that already exists, hard assets that you can touch, and a flight away from intangible assets, stocks and bonds that signal the creation of future wealth. Is it any surprise then that housing soared under George W. Bush? I don't think so. The dollar was devalued. Of course, Republicans back then didn't think there was any inflation, but that with the dollar in decline, logically commodities did well yet again. If you look at the present, I think you'd probably agree with me that the dollar is still weak, but it just hasn't weakened under Biden. And so Republicans are trying to tie this inflation to Biden. And to be clear, Biden's an empty suit. Okay, he's not the very bright, settled science. But we are setting ourselves up for embarrassment, as you allude, by redefining inflation altogether and define it in such a way that's going to hand the other side a victory.
Do you think, to your point back on housing for a second, that if the semantics are changed a bit to be more precise, to account for the economic laws you're talking about, is it at least acceptable to point to prices being distorted? In other words, the government plays an unhelpful interventionist role that makes things in an isolated description, housing as opposed to the entire economy, that it creates price escalations that were entirely avoidable through unhealthy inorganic interventions in the market.
It's a great question. I'll answer it with this. Isn't it interesting that in the 2000s, when housing was soaring in the United States, that it was also soaring in England, which had gotten rid of the mortgage deduction in the 1980s? It was soaring in Canada, despite the fact that it's exponentially more difficult to get a home loan there than it is in the United States. It was a worldwide phenomenon. And what I tied it to in my book, Popular Economics, was we shouldn't be surprised. The dollar is still the world's currency. And when it declines, currencies around the world generally decline, not as much, but they decline with it. And so what the circumstances driving a housing boom, a weak dollar, applied globally. And that's what happened. But one of the
But
things
what about the declining cost of capital that was more universal? And so in UK and Canada, they also had that downward pressure on borrowing rates. That would be perhaps the one shared circumstance, no?
Very good question. You're more in finance, so let me try this on you. To me, housing is the surest sign of investors moving away from risk because housing is a recoverable asset. So how I've always described what happened in the 2000s and in the 1970s is, yeah, with the dollar weak, banks directed everything towards something that was safe, and housing's the ultimate safe. I mean, you look in the 2000s, most of those home loans ultimately performed. You know, everyone said, "Oh, they're all sloppy loans." Well, actually, most of them performed. And so was capital cheap? I think not. Look, how much did it when Uber was searching for capital, they sold 20% of themselves for about $10 million. Google, you could have gotten, I think, around 30% for less than that when Google was searching for capital. Capital is incredibly expensive in the real world. Housing, because it's a tangible asset, is logically it's going to be cheaper there. I don't think the Fed had anything to do with it. I think that's a myth. The idea, the notion that the Fed could make capital cheap is like saying the mayor in New York could make apartments cheap and plentiful just by decreeing them so. Capital was cheap for housing because that was the safest place to go.
I'm sympathetic to a lot of that, although I think that there are other circumstances that became relevant in that crisis. So the deterioration of underwriting and essentially resulted in, I think, a flight to safety argument would imply that people had skin in the game, that they were actually investing in housing with their capital. But because of the non-recourse financing in the very few states that basically were ground zero for the housing crisis, that you ended up, what really put us over the edge, what could have just been a kind of frothy market that ended up correcting, which has happened many, many times in American housing history. But what became what we call the implosion really was isolated in California, Arizona, Nevada, Florida, almost not at all existent in Texas. And the reason being that people were able to essentially do 0% money down trades where there wasn't so much a fight to safety for their capital, but a little game of whack-a-mole and fundamentally more speculative and Ponzi-like. So there's other things that ended up entering the fray. And I'm sympathetic to the Austrian argument that the Fed that Greenspan's lowering of rates helped facilitate it, but I've never been able to get comfortable with the argument that it caused it. I think that, again, we tend to want to simplify things and resist multi-causal explanations. And I suspect that all of those issues related to the financial crisis are uncomfortably multi-causal. That there was just not only different causes, but in fact, different crises that required a cause. Because as you point out, things were different in Canada than they were. The rate of increase, the UK didn't have a mortgage interest deduction, but they still ended up with a housing market correction. We kind of throw the kitchen sink at cozying up to our housing market. Ours was much worse than UK's, but they were both bad. It just seems to me that there's a multiplicity of factors, but I do think that government interventions across the board were unhelpful. Now, you eliminate all of it, eliminate the subsidizing of Fannie Freddie, make underwriting be a more pure market process like it would be to get a loan for a business or whatnot. Would you still have had a financial crisis? I suppose it's possible. I think it would have been much less. It wouldn't have had as much hair on it.
Oh yeah, there's no doubt. My quibble with it, and my sense is, I think you might agree, is I've always been bothered by financial crisis. No. It was a crisis of government intervention. If they don't save Bear Stearns, investment banks have been failing forever. When I was at Goldman Sachs, that was the first thing they did to us on the first day. They said, look at this deal tombstone from the 1950s. How many of these entities still exist? Their point was one mistake can cause us to go down, so don't mess around. And if Bear goes under, was the world going to end? Certainly not. Probably Lehman dies the following week, but investment banks are wonderful entities that are just a collection of talent. The crisis was the Bush administration intervening. And Bush's classic line saying, I believe in free markets, but they're not working right now. No, markets just are. Markets have no opinion or ideology. If they don't intervene, there's no crisis. Now, we can look at other things. Obviously, government's been in bed with housing for quite some time, as you allude. But the rush into housing was global. Let's add that in the 1970s, the Fed was actively raising rates, yet housing was soaring. Let's add that we've had these Fannie Freddie and all this for decades. But it's only in decades where we wreck the dollar that there's this headlong rush into hard assets. And so I think all of these things are factors. You and I want a world without the intervention. But what I think sadly both sides have forgotten is that the dollar is the most important price in the world. And if you had a stable dollar, a lot of this other stuff we're not talking about.
And so, what do you think, John, are the things that can be done to create a strong and stable dollar?
That could happen between breakfast and lunch, to be honest. If President Biden were to say, we think that the dollar's instability is very problematic and we are going to start targeting something, some would say gold, someone would say the Swiss franc. Let's not get into what they would target. But a stable currency is basic. Let's not forget, as I point out in my upcoming book about, well, money and inflation, and I wrote it to reject all this nonsense that's out there right now, is that Germany ended its hyperinflation in a week. They just issued a stable currency. If we want a stable dollar, we can have one. But I also sense that the future's coming at us quickly. The collapse of the crypto is the surest sign that crypto has a bright future. It's a sign that markets are real, that they're kicking out the bad ones, and that we're going to gradually move toward cryptocurrencies that are stable in value, that are no longer a speculation, that are a concept of stability. And so even if Treasury doesn't get serious about a stable currency, which would be a non-inflationary currency, I think market actors are going to give us one, and that this future is a lot sooner than we realize.
When you say targeting, and for our purposes, it doesn't matter what they'd be targeting, the point would be demonstrating a seriousness about defending the currency by having a rules-based peg. Since we went off gold standard, it would sort of be replacing it with something new. Would you be comfortable with a commodity basket?
I'd happily do a commodity basket. I would probably prefer gold over the commodity basket, not because I've got some religious devotion to gold, but because it's been historically used as money. It was the market's choice as a way to define money simply because it's so stable. And so you could throw silver, oil, aluminum, others that are just not as stable as gold are. And they're not because we consume all the oil all the aluminum that we bring to market every year. We consume all the oil. Gold doesn't have many industrial uses. And so the stock flow scenario with gold is really remarkable, which is why it's always been used as money around the world. But I would take anything because a government adopting a standard would be all the market signal that investors would need that, yes, we are serious about money as a measure of value, a stable measure of value. And so what we'd get from that would be incredibly profound in terms of what the subsequent prosperity that would come from this, the subsequent growth of all sorts of amazing advances that we're not getting now because so much money is locked up into hedges instead of being directed toward wealth creation.
Do you think it's interesting as you say that? It just occurred to me that you could be right on the gold side in the exact opposite way that that the gold bugs have been. And what I mean by this is their syllogism forever has been inflation's going up, gold protects against inflation, therefore buy gold. And now the challenge has been inflation went up, gold hasn't gone up, therefore we were wrong. You might actually be defending them but by pinpointing that it wasn't their second premise that was wrong, it was their first premise that was wrong. In other words, that you could effectively argue, don't think that gold failed you here, but that your definition of inflation failed you here. Am I onto something?
Oh, you're fully onto something. I argue in my upcoming book that some of the worst advocates, in fact, all the worst advocates for a gold standard or good money are gold bugs. They embarrass us at every turn because they don't understand what it is they're arguing for. They claim that gold would restrain governments. Actually, no, it wouldn't. If governments are offering up debt that is defined in terms of gold, that would make debt more attractive, not less. They say that it would restrain the growth of government broadly. In fact, it wouldn't. An economy that had a stable currency would grow quite a bit faster than the one today, which means that government revenues would sadly increase. So everything they assume is incorrect. But what we know, all the evidence we need that gold is a very good way to define currency is to look at currency markets. It's so easily forgotten that there weren't currency markets before the 1970s. Why would there be? Not only was the dollar stable, but global currencies were pegged to the dollar. So why would you trade currency? And if Adam Smith were alive today, he'd say, what, you trade currencies? The only purpose of money is to move goods. It's just this low entropy concept, this measure that we use to move the real wealth around. But now there's 10 trillion in currency trading on a daily basis. That's your evidence of how much the markets yearn for currency stability, because they're not doing this for their health. They're doing this because money in its present form, even the good money, isn't very trustworthy.
And so the idea about gold maintaining purchasing power and utilizing it as an investment vehicle, and of course gold being at $800 in 1980, and now at 1,800, it's about half of what that purchasing power, quote unquote, would have gone to. Your point there is that they're making the argument wrong. They're arguing for the right thing for the wrong reason from your worldview.
Yeah, no, they don't have a clue. Everything they're promising with gold wouldn't happen, and then they're under promising what would happen.
So
Assuming
John,
a gold,
is it possible that the same thing is happening in spades with crypto? That we were told 2 years ago, central banks are out of control. Fiat money is a debacle. Digital currencies will eliminate this, and you'll get this great inflation hedge called Bitcoin. And it doesn't really seem to play it out that way. And I wonder if you could make the same argument. It's in your mind, it's not a problem with blockchain. It's a problem with what they said was the point of it to keep up with inflation.
Yeah, look, you nail it. That's exactly it. Same idea over, and I've written this, that the people who are promoting crypto haven't a faint clue what it is they're promoting. And you see it, and then they say, well, they're still discovering gold, but Bitcoin is limited in supply. Except for good money, you can't supply enough of it. And see, what are the gold bugs saying? They're saying if we go back to a stable, a gold standard, we're going to limit the supply of dollars. Actually, quite the opposite. If the dollar had that kind of credibility, its circulation around the world would skyrocket. And these same ding-dongs would be saying, oh my gosh, inflation, because at heart, they're monetarists. And they promised the same thing. They said, well, Bitcoin's limited in supply. What the on earth does that have to do with anything? If it's a good currency, you'd want it. Logically, markets would expand its supply over time. It'd be production determined. Everyone would want Bitcoin. And so they're promising something based on a fundamental misunderstanding about money. Money can't be oversupplied if it's credible. What the market wants is credible money that holds its value throughout time. It doesn't want something that's scarce any more than a currency like the Argentine peso. They say, well, they could increase its supply. No, they couldn't. You can't increase the supply or circulation of a monetary concept that is not trusted. The only monetary concepts that are circulated with regularity are ones that hold their value.
I will bring us near an end here by pointing out something I think is much more important. Underlying all these things you point out they're getting wrong. And I don't think we can expect these people to define monetary challenges correctly, to define inflation correctly, to diagnose solutions, when the very thing at the heart of all of this is fundamentally not defined correctly, which is the definition of wealth. I don't believe that we have trained people to understand what wealth is. And we can say things that unfortunately sometimes sound like platitudes, and they're not platitudes for me. When I teach high school students economics and I say, would you rather have a lot of dollars or a lot of goods and services? It doesn't take that long for them to get where I'm going. to understand that someone with this incredible access to goods and services is wealthy, and someone with a bunch of dollars without goods and services is not, or dollars that can't buy goods and services is not. The notion of wealth being this idea of output and that enhances quality of life because of the rationality of human action. When we don't get that right, it seems that we guarantee we're going to get all these other things wrong.
Oh, you're absolutely right. Amen, amen, 1,000 times over. People need to know that we could burn up every dollar in the world today, and the U.S. would be the richest country in the world tomorrow still because we are the wealth. And I would add that the U.S. would be brimming with dollars tomorrow, with currency tomorrow, moving the genius of Americans around the world and around the United States. The wealth is in the people. It's not in money. Money is how we measure it. And a failure to understand this has tripped up Republicans, conservatives. It's tripped up Democrats. It's tripped up Austrians who, if von Mises were alive today, he would be horrified at what's being done to his thinking in much the same way that Keynes was horrified by what his disciples did to him. Well, it seems we agree, and it's just terrifying to watch this debate unfold.
Well, I agree with you on both counts, and I'll let listeners decide what they think is worse. The one thing that I will say is that some of the people talking the way they are right now about inflation, I don't think believe what they're saying. I think that it's opportunistic politically, and in their minds, maybe even necessary. I mean, it's certainly a layup. I'll give them that. You're going to get your 5 minutes on TV. You're going to get your applause. And I do think that this narrative is going to stick around the Democrats to some degree in the midterms. But I don't think all the people we're talking about really believe it. I think more of them know what you and I are talking about than let on. There's some that I think need to be walked through and have this conversation, but I'm not sure. Some of the folks that are going down this other path are way too bright to believe what they're saying.
I think you're right, but I also think that's dangerous because, as you allude, if they continue in this direction, it's going to come back to smack them because what they're describing as inflation quite simply isn't.
Yeah. Well, John, thanks so much for your time. There's a lot of conversation extensions that can come out of this. I think that listeners hopefully at least had their thoughts provoked. I know I did. I appreciate reading you very much, and we're really hoping hope you'd come back on Capitol Record again.
Anytime. What a treat to come on. What a great discussion. Thank you so much for doing this with me. It's very much appreciated.
Well, my pleasure. Thanks again. Well, I really hope you enjoyed that discussion. I will tell you that it's probably one of the more provocative episodes we've had. There's a lot there that goes against the grain. There's a lot there that some people may disagree with. There's a lot less there people would disagree with if they were willing to totally unpack exactly what is being said and not being said. There's some levels of semantics and vocabulary that are going on. But my point is that he really does make very compelling arguments for his position, and I'm grateful to have had John on. It's interesting to hear his stuff on crypto at the end. A lot of you know my skepticism about it, and yet in a very interesting way, John's agreeing with me in the sense that I have talked about all the things that the crypto community has said it will do that I do not believe it will do. And John, from a pro-crypto standpoint, is acknowledging it won't do those things and criticizing the crypto industry for effectively false advertising, for not understanding the merits of their own argument or what ought to be the merits in their own argument. I am aware of what some parts of the conversation people may need a little more time to digest, but I hope you'll just do that. Digest it, process it, think about it, and understand that fundamentally there's a lot of common ground here for defenders of free enterprise. There's a lot of shared beliefs as long as you start with this premise that wealth is the ability of human beings made in the image of God to create goods and services that enhance quality of life, that meet human needs, that is what wealth is. And a lot of the debates that exist then around the dollars or other currencies that serve as a medium of exchange between those goods and services, That stuff is far less problematic and controversial than when we actually impede the cause of goods and services. In other words, impede the cause of wealth creation. So John is really consistent in what he wants to drive economic prosperity. There's room for disagreement on how we get there and what some of the shorter term impacts may be. I think there's a couple points where John and I might disagree as to how quickly some of the things could play through, but I don't disagree with him that ultimately any nation serious about a strong currency will have very little else to worry about when they remove impediments to production and to output. And that a lot of our talk about inflation is really misguided talk about other elements of economic administration gone wrong. I'll leave it there and let you digest it. And we will very much look forward to another episode of Capital Record. We have some great guests coming up in the weeks ahead. I appreciate you listening. I hope you'll rate us. I hope you'll even rate us with 5 stars. And I hope you will subscribe as opposed to listening on a website, just so we can drive our numbers higher and increase our traffic for those who are interested in the cause of a free and virtuous society. Thank you for listening to the Capital Record.